Hello, everybody. Hope you had a great Thanksgiving break. Every Wednesday at 12:30 Eastern Time, a Fuqua faculty member is going to discuss interesting topics on LinkedIn Live. And today, I'm going to talk about regulation related to short selling. So my name is Xu Jiang, and I'm an accounting faculty member in the Fuqua School of Business. If you have any questions, feel free to type them in the LinkedIn, and I will be alerted by those questions when we come to the question time later on. So you might be wondering why I, being an accounting faculty member, is interested in short selling regulation. Well, my general research interest is related to the benefits and costs of regulation. And because I'm an accounting faculty member, so the focus is on accounting regulation. And as the short selling regulation I'm going to talk about today relates to feedback effects and coordination failure. These two topics that I'm going to explain in more detail later on. And I have done research related to optimal accounting standards in the presence of these two forces. So that leads naturally to my study of short selling regulation. And speaking about short selling regulation, short selling bans are very common during crisis periods. In the most recent COVID-19 crisis, European countries, including France, Italy, Spain, Austria, and so on, some Asian countries, including South Korea, Saudi Arabia, they temporarily banned short selling. Thailand and the United States, that increases the cost on short selling. And during the last crisis, which is more than 10 years ago, the global financial crisis, the United States and many other countries, they temporarily banned short selling. And short selling ban is also a very controversial topic. There are both strong arguments in favor of and opposing the ban. Let's start from the opponents of the ban. The opponents of the short selling ban says that banning short selling is like shooting the messenger. Because their opinion is like short sellers are considered to be the investigative journalists of capital markets. They're exposing failed business models, bad management, and excessive leverage. Here, just to give you an anecdotal example to support their arguments. Long before the failure of Lehman Brothers during the global financial crisis, there was a hedge fund blogger based in London. So the hedge fund blogger ran a reader poll. And the poll is about which financial institutions would be most likely to fail if a crisis were to occur. And not surprisingly, Lehman Brothers won that poll by a large margin. So you can already blame short sellers for Lehman Brothers for bringing Lehman Brothers down, because Lehman Brothers has issues with its business models and management. And we can think of more examples, including, for example, Enron, WorldCom. Any bad company is usually related with a short seller. So if you ban short selling, you're shooting the messenger. You're killing the transmission of bad but truthful information. On the other hand, the proponents of short selling ban saying that the ban is necessary because short sellers generate rumors, create fear and panic, and brings down good firms. So essentially, firms are good, but they were brought down by short sellers who are spreading rumors to enrich themselves. So again, I'll give you two anecdotal examples, and these are all from CEOs. So for example, during the last global financial crisis, the share price of Morgan Stanley in one day fell 24%. And so the CEO on that day wrote an internal memo to their employees, basically saying that we're in the midst of a market controlled by fear and rumors, and short sellers are driving our stock down. It's not like we're doing bad. Another example comes from the very famous entrepreneur, Elon Musk. Many of you may know that Elon Musk is not a big fan of short selling. And his comment about short sellers is basically saying that they're constantly trying to make up false rumors and amplify and rumors. So as a summary, the opponent of short selling ban says you should not kill the messenger. And the proponent of short selling ban says that short sellers, they're just make up stories and try to bring down companies. In this study, I actually show that both stories have merits, and we can incorporate both stories in a model. And this model is going to give implications on when you would ban short selling or when banning short selling would be most effective. And in our setup, in our story, the shooting the messenger refers to informed short selling. Because messenger means that you have information, you know that the company is doing bad. And so you're trying to trade to make money. And the generating rumors part refers to uninformed short selling, which by definition means that you don't know any information. You don't have any information. And you're just trying to short selling to enrich yourself and at the same time bringing the company down. So a natural question is, how can an uninformed short seller make money? So we have stories from behavioral finance, which tells when, why the uninformed short sellers can make money. But our study is based on this more traditional, rational framework, which means everybody is trying to optimize their decisions and satisfy certain rules. And so in this case, there is generally no role for uninformed short sellers to make money. And the reason is, if you know nothing about the company and you're just trying to trade, if you buy, you're going to push the price up. If you sell, you're pushing the price down. So you're always going to buy high and sell low. And in the process, you're going to lose money. However, there is this effect that we can use to let uninformed short sellers make money. And this effect is the feedback effect. So this is a technical jargon, but what it really says is that stock market contains information that is useful for management to make decisions related, for example, whether to continue or cancel a project, whether to continue or cancel acquisition. And so this feedback means the feedback from the stock market, from the trading prices to the firm, to the manager, to the decision maker. There are ample empirical evidence on the feedback effect, but I'm going to give you an anecdotal example. So on November 20th, 2000, there is this report from the Wall Street Journal saying that Coca-Cola was in talks to acquire Quaker Oats. And shortly thereafter, Coca-Cola confirmed the discussions. The market reacted negatively. So Coca-Cola is a blue chip stock. Usually we think of blue chip stocks as very stable, not very volatile. And so they were down 8% when the news comes out on November 20th. 8% on a single day, and then 2% on the next day. And Coca-Cola's board of directors on November 21st, after the stock price dropped 10% consecutively on 2 days, they rejected the acquisition. They canceled their acquisition. So they were saying we're not in talks anymore. And this is attributed to the negative market reaction. But what it means is that the decision makers in the firm, they do learn from stock market prices to guide their decisions. And this feedback effect actually results in the possibility of uninformed short selling. So here is the story. Suppose that without any information from the stock market, the firm thinks its project is positive NPV. They would like to continue the project. In this case, the uninformed speculator, they can try to short sell the stock. When they short sell the stock, of course, they're bringing the stock price down. The firm sees the stock price is going down, just like the Coca-Cola case. But they don't know whether the stock price going down comes from a negatively informed speculator, which really knows that your project is not good, or an uninformed speculator. Because the firm learns from the stock price, they still think that there is some possibility that this comes from a negatively informed speculator. So the firm chooses to terminate the project because this project actually is positive NPV in the absence of any other information. So when you terminate a project, you're terminating a positive NPV project. And of course, that results in a price drop. That results in a decrease in firm value, and that results in short seller making profit because your price drops, and short seller benefits from price drop. The same logic would not imply that the uninformed short seller is going to buy, because when you buy, you're just confirming the firm that the project is worthwhile pursuing. But when you're buying, you're pushing up the stock price. So you're buying at a high price and you're going to lose money. So for uninformed short seller, with the feedback effect, they're going to short sell, but they're not going to buy. And this short selling results in termination of positive NPV projects. And that relates to what we were talking about. They bring down good firms, they bring down good projects. However, If you only have this feedback effect, a blanket ban on short selling is a bad idea. And here's why. For this feedback effect to work, for the firm to try to learn from the markets that this, there is some information from the market, it has to be that there is some probability that this short selling comes from informed speculators, from the messengers. If I'm the manager of the firm, I know that this short selling is just nonsense from somebody uninformed, then I'm not going to do anything. And so in this case, the feedback effect is not going to work. So for the feedback effect to work, the probability of being a messenger has to be sufficiently large. So you have to sufficiently amount of informed trading. And so in this case, when you do a blanket ban on short selling, then you're kissing the messenger. You're killing the messenger. And at the same time, you're killing these rumor-based speculators. But because you need the amount of informed trading to be sufficiently large, you need the presence of messenger to be sufficiently large. So the efficiency loss from shooting the messenger is larger than the gain from avoiding this rumor-based speculator. As a result, a blanket ban on short selling is not good when only feedback effect is there. However, things are going to change if we're adding another element, which is the coordination effect that I have alluded to earlier. So the coordination effect, this is another technical jargon. It's related to what we call the strategic complementarities. So what is strategic complementarities? Strategic complementarities means that you and I, our strategies are complements. And when I say our strategies are complements, means that if you're doing one thing, I better doing the same thing than doing the opposite. So let me give you examples of this strategic complementarities and coordination failure. So for example, on the positive side of this example, suppose all my friends are using Facebook rather than MySpace. In this case, I would better off also using Facebook rather than MySpace, because I'm going to get more connected to my friends on Facebook versus MySpace, where nobody is using that. So that's the positive side of this coordination effect or strategic complementarity. On the dark side, the strategic complementarity would refer to, for example, bank run. If others are going to the bank to get their deposits out, I would better do the same thing. I would just run to the bank, get my deposits out, because I'm not sure that the bank is going to survive if so many people are going to get their deposit out. If the bank is running out of resources, there is no money left for me. So in this case, I would also choose to get my deposit out. That triggers a bank run. And there's a prominent example of the bank run during the global financial crisis. A British bank, Northern Rock, actually was run during the global financial crisis. And you can actually see photos or videos, if you can find that on YouTube, of people actually literally waiting in line outside the branches of the bank trying to get their deposits out. While bank runs, they're rare due to deposit insurance. There are documentation of runs on mutual funds. So another prominent example from the global financial crisis is when Lehman Brothers go bankrupt on September 15th, 2008. The next day, a single money market mutual fund, actually the net asset value falls below the typical $1 book value for those money market mutual funds. Because those money market mutual funds, they invest in those very low risk securities, which means that typically when they set their book value to be $1 per share, their net asset value is going to be above $1 or at least $1 all the time. But because this single money market mutual fund invests in Lehman Brothers commercial paper, so the net asset value actually falls below the book value. And this triggers billions of dollars in investor redemption of this mutual fund called the reserve primary fund. Runs not only occurred to this fund, the following day, the run-like behavior spread to many other money market mutual funds. There was a huge run. So even those money market mutual funds, they're not holding Lehman Brothers commercial papers. So they're not affected by Lehman Brothers going bankrupt. They're still being run by the investors, because if I'm concerned that you're going to get your money, I also want to get my money, because I'm concerned that the fund is going to run out of the money and I'm not going to get anything back. And our study shows that when introducing such coordination effect, in this case, even when the feedback effect is not as strong as before, uninformed speculators can benefit from short selling, can introduce panic into the short selling, and resulting in such trading becomes profitable. So here's how this is going on. Remember, previously, we need feedback effect to be sufficiently strong because we need firm to actually know that the short selling has some high likelihood to come from informed speculator. Now, such concern is weaker. The reason is I'm the investor and I see a price drop and I see somebody selling. And I don't really care much about whether this selling comes from an informed speculator or a non-informed speculator. What I care about is others also see the price drops. Others see that the firm could be failing. And so others are concerned that their investments may lose value. So they're going to choose to withdraw their investments. And if I'm concerned that others are going to withdraw their investment, I want to withdraw as well. And I don't really care whether or not the selling pressure comes from an informed speculator or uninformed speculator. Just like in the money market fund example that I talked about, even if their funds are not really related to the bankruptcy of Lehman Brothers, I still want to get my investment back. So in this case, even when the probability that an uninformed speculator being present is not large, uninformed short selling is going to trigger panic from other investors, from this withdrawals, from this coordination effect. And this self-fulfilling withdrawal of investments, again, is going to result in a firm terminating positive NPV projects. Because a lot of investors are asking to withdraw their investment. There's just simply no money to continue investing in these positive NPV projects. So positive NPV projects are canceled, firm value further drops, the uninformed short sellers benefit from the dropping of the price, and that results in a loss because positive projects get terminated and good firms, they get penalized. And so in this case, we actually show that a blanket ban on short selling is beneficial because we already talked in this case, you don't really need the probability or the magnitude or the extent of informed trading, informed short selling to be high. Even when the extent of informed short selling is very low, you could have these uninformed short selling triggering panic and triggering price drop. So in this case, when you ban all short selling, the loss from shooting the messenger is very small because there are just not much messenger around. But you're going to have a lot of benefit from avoiding these uninformed short sellers to just attack the firm, create panic, and hurting the viable firms. And so the implication of our paper is that the short selling ban is going to be beneficial when the coordination effect is strong, which results in the probability of informed trading to be low. And so crisis periods, they're characterized by lower amount of informed trading. Because during crisis period, for example, the global financial crisis or the current COVID-19 crisis, nobody really knows what's going on. The uncertainty is high. And so if there is any amount of short selling, a lot of the case is likely due to uninformed short selling. In addition, the financial institutions, they're prone to such coordination failure because they're relying on investors trusting their financial institution and putting their investments, deposits in the financial institution. So once it triggers a run, then it's very hard for the financial institutions to come back. Therefore, we're saying that there is a merit of banning short selling to financial institutions, in particular during crisis periods. Our implication actually is consistent with the SEC's arguments, the Securities Exchange Commission's arguments when they banned short selling during the most recent global financial crisis. So on September 19, 2008, 4 days after the Lehman Brothers went bankrupt, so SEC stated that under normal market conditions, short selling contributes to price efficiency and adds liquidity to the markets. At present, which means as September 19, 2008, it appears that unbridled short selling is contributing to the recent sudden price declines in the securities of financial institutions unrelated to true price valuation. This is consistent with what we were talking about. Under normal market conditions, you don't want to kill the messenger. But under this market conditions, you have uninformed short selling and bringing price down, even though the firm is doing good. And so financial institutions are particularly vulnerable to this crisis of confidence and panic selling because they depend on the confidence of their trading counterparties in the conduct of their core business. And that's consistent with what we were saying. Financial institutions, they're prone to this coordination effect. It's just people run even though your institution is sound. And that's why during the global financial crisis, the SEC actually imposed short selling bans. And a lot of the short selling bans are related to financial institutions. In our paper, our study provides such explanation. Okay, so that's the core of our story. And now I'm ready to take some questions. So here is one question. So the question is, why does the United States not imposing short selling ban this time? I mean, this is a very good question. And so what I'm going to do is I'm going to base that on conjecture. So why did the US not impose short selling ban this time? I think it's related to the United States learns from the global financial crisis last time. So the Federal Reserve actually is providing ample liquidity this time versus last time. And when you provide a lot of liquidity, it is like you're providing insurance. And that would alleviate or actually even eliminate the run on financial institutions. So the intuition is as follows. So why do I choose to run? I choose to run on the financial institution because I'm afraid that others are going to run and I may not get my money back. If you provide insurance, if you say you're going to get your money back for sure, then I'm not concerned about not getting my money back. And so in this case, I'm less willing to run. And when enough person chooses not to run on the financial institutions, then the ban is going to the run on the financial institutions is going to be alleviated. So in this case, when the coordination effect is not there, then you don't want to impose short selling ban. And that's kind of consistent with our story. Our story is that you only ban short selling when coordination effect is sufficiently severe. In this case, because of the support from the Federal Reserve, and so the coordination effect is not that strong, which is why no short selling ban is imposed by the United States. But for other countries, when there are central banks, they may not provide enough liquidity support. Then for those countries, that's why they choose to impose short selling ban. The second question is there a better way of avoiding uninformed short selling other than a blanket ban or a ban on all short selling? That's also a good question. And so the reason that we're talking about imposing a blanket ban is because it's fairly easy to execute. So in our study, the uninformed short sellers, even though they're making profits, the profit is always smaller than informed speculators. And the reason is because the uninformed speculators has no information relative to the informed speculator. They're relying on investors' panic. So overall, their profit is smaller. So in this case, a better solution would be increase the cost of short selling such that it would make uninformed short selling to be unprofitable, but make informed short selling to be profitable. If you set the cost to be larger than the profit from uninformed short selling, but smaller than the profit of informed short selling, you would be able to achieve that. In this case, you're keeping the messenger in, you're keeping the informed short selling, but you're driving out the uninformed short selling. So this would be a better way than a blanket ban. But this requires knowledge of knowing how much profits informed short selling makes, and how much profit uninformed short selling makes. And so this is not as easy to execute as a blanket ban, because in this case you don't really know which person is informed, which person is uninformed, and how much is their profits. And so you can just impose a blanket ban. Okay, so I don't see any more questions. So I just want to do a little bit of wrap up. So the bottom line of our story is that there are merits to both arguments of banning short selling. So first is banning short selling indeed kills the messenger, because it drives out informed short selling, speculators who know that the firm is not doing good. It also, the story that the speculator actually generates panic and brings down good firms also has merit, because in our case, because the firm learns from the markets, the uninformed short seller can exploit that and brings down good firms. And then whether or not short selling ban is beneficial depends on which force dominates. We show that when this coordination effect is strong, and when the probability of informed short selling is small, which corresponds to financial institutions during crisis period without enough support from the central bank, then a good solution would be ban all short selling, such that the benefit from avoiding these uninformed short selling is going to dominate the cost from shooting the messenger, from killing these informed short selling. Okay, so that's all I have for today. And next week, we're going to pause our LinkedIn Live series for a Fuqua-wide event called Sustaining the Awakening, Our Roles in Fighting for Racial Equity. We'll be back on Wednesday, December 16th, when our Dean, Bill Boding, who is the leader of our business school, is going to provide insights on leadership during challenging times like this. So stay tuned on LinkedIn Live. And I hope all of you have a great day, and hope you will join the next LinkedIn Live series.